I think there's sort of like a gradually then suddenly inflection point. This becoming a real discussion across, corporate boardrooms. The asset is maturing, and this is a way, if Bitcoin is going to eat the world, and that's what kind of a lot of us came to the conclusion of 5 years ago, then it's not going to be everybody just buying Bitcoin on cold cards. There's huge pools of money that can't access the asset. Equity on the stock market was just the first pool. And, really the bigger market in terms of exposure is the credit markets. It's just a much, much bigger game. The pools of capital are huge.
All right, Dylan LeClair, probably the most prolific 20-something in the world. How's it going, man? Last time we spoke was, I think it was like just around a year ago. Metaplanet had a couple of hundred Bitcoin on the balance sheet or something like that. Now you're at like 16,000 and a bit. What a wild year. How's it been?
What a wild year indeed. Appreciate you having me on, Danny. It's been a crazy year. You've managed to boot Peter off the podcast and take the reins.
Hostile takeover.
Yeah, congratulations on that. It's been exciting. I don't even know where to begin, but I feel like the last time we spoke, the situation was a bit different. So a lot to catch up on.
It was very different. And I know you're a busy person. I don't know how much you listen to the show, but I've been pretty skeptical about a lot of the Bitcoin Treasury plays. And for full context, I think strategy is its own beast. That's different. I think Metaplanet, again, for a couple of reasons, one being super early and then also being in Japan, you're probably different. And I think there'll be a handful of others that do really well in this. But I'm kind of skeptical about these new treasury companies that pop up every week. It seems like almost one a day at the moment. What's your kind of read on the entire market for this?
Yeah, one is I think for the last 4 or 5 years, I would say I've tried to be a champion of Bitcoin, no matter what the circumstance, up, down, sideways. So it's amazing to see, the Bitcoin Treasuries.net, there was, 10 companies, 20 companies a year or two back. And now there's like 200 companies around the world racing to announce and acquire Bitcoin. So, this is, I think it's unilaterally positive for our mission. Even if you are, the cypherpunk sort of, the cypherpunk minded Bitcoiner, the crypto anarchist, if you will, what did you think Bitcoin winning and taking over the world looks like, right? Well, one of those avenues is, the public capital markets are going to embrace it. It wasn't just going to be like a libertarian, toy, right? But I let me clarify, like I'm not dissing or putting away the cypherpunk anarchist sort of view. They exist in parallel, right? Saylor leveraging the preferred equity market, with its Bitcoin collateral does not inhibit, any of the other use cases or the Lightning or any, Lightning Network or anything of that extent. So, I think that I sort of naively in 2021 thought that this would happen really fast. Saylor adopted it. And, Pierre was like, 500 companies in the S&P 500 are going to adopt Bitcoin. And I was like, yes, like 100%. And so, for me, I was a bit of, I was in a bit of disbelief that I had the opportunity, even though, Metaplanet was in the Japanese market. I'd never been to Asia. I don't speak the language. I didn't know the first thing about Japanese public markets at that point last April. But the opportunity for me to work at a public company, with a Bitcoin first, Bitcoin, only vision was really exciting because at that point there was, it was MSTR and some miners and, Coinbase. So, a year out to see, 50 announcements in the last week or two, if nothing else, it's vindicating. Because, I think we had this vision as Bitcoiners, and Saylor was out there tooting, his horn about this, begging companies to copy him, and no one did, right? And so I think there's sort of like a gradually then suddenly inflection point that we've, whether we've passed it in the grand scheme of things or we're nearing that inflection point where, it goes from, sort of the gimmick like, hey, we're doing this because we get attention and volume and liquidity, in our equity, to, this becoming a real discussion across, corporate boardrooms, right? Is like, okay, we're still going to have our business, but at the same time, it makes sense to, accumulate this and sit on a bunch of cash. What was it, like Figma, right? Figma's going public.
Yep.
They casually had $50 million of Bitcoin on their balance sheet. Yep. No one at Figma is talking about Bitcoin. They don't have a a dedicated, Bitcoin strategy officer that I know of. But at the same time, they have 50 million of Bitcoin. Like, that's not a joke. That's a lot of money, right?
Uh-huh.
So I think that this is where this is all going. In terms of the scale or the capacity for, however many purpose dedicated Bitcoin only accumulation vehicles that are, we'll see. I think there's obviously going to be a dominant monopoly in each of the largest local markets, right? There's just economies of scale that, there's a winner take all dynamic. Even though the Bitcoin, it's homogeneous collateral, it's fungible, right? Like, in theory, one Bitcoin equals one Bitcoin no matter what company holds it. But in reality, I think, in public markets, there's just a dynamic of size and liquidity, never mind like the passive indexation, right? So there is somewhat of a winner take all or winner take most dynamic, especially, in the various public markets. So yeah, I mean, I think it's all extremely positive. I've been really, really encouraged to see, more and more people, whether it's reaching out to Metaplanet, or there's been companies, I think there's now, 10 or so companies in the Japanese public market that have a little bit of Bitcoin. And I think, Metaplanet has certainly been, kind of a driving force there. So it's really cool to see it. And, to be frank, I think we're still in the grand scope, the grand scheme of history. I think we're still in the early innings of, the Bitcoin corporate adoption story, even though, all of the Bitcoiners, if you will, in our own echo chamber are like, oh, okay, guys, this is really frothy. The reality is, like, the rest of the world actually simply doesn't care.
Mm-hmm.
So I think it is pretty early, despite, what everyone sort of believes is, everyone thinks it's reaching a fever pitch. But I think if you step back, it's actually, we're still, in the huge pools of global capital, we're still, this Bitcoin story is still pretty small.
So when I've just pulled up the BitcoinTreasuries.net website, and there's like such a crazy drop off from Saylor at like 600,000 Bitcoin. I think the 100th in the world right now is at 25. So like there's an enormous gap between those two things. But how much demand and how much of a market do you think there is for these Bitcoin treasury companies that trade at an actual premium to net asset value, like something significantly greater than one? Like, because one of the things that I've been sort of trying to figure out is whether we're going to have a lot of these that trade basically just at par, and then a couple that will be at 2 or 3x. And like, where do you think that goes?
Yeah, I think it's a constant like fight with gravity, if you will. Above 1x mNAV. You just think of the math and the mechanics, right? Like, if your stock's at a 2x premium and the stock price is flat and you buy some more Bitcoin, your premium to NAV goes down. If Bitcoin goes up, your premium to NAV goes down, right? So in order to say, stay at a constant 2x premium, if you will, every time you buy Bitcoin, the share price has to ratchet higher, right? So it takes more and more capital. So that's why I think there's a sort of a natural trend towards a winner take most dynamic.
Yeah,
is because the liquidity you need to sort of maintain a consistent premium, especially as you scale a treasury ideally exponentially, right? Like, for instance, a 5x premium when Metaplanet was a $10 million company was $40 million of value, or when we were a $50 million company, or whatever whatever kind of math you want to do, is really, really small in terms of the value. Right now, Metaplanet's I think we're a $5 billion company, right? So at a 3x mNAV, that's billions of dollars of premium. Strategy is at a measly 1.8x premium, but the premium is like $50 billion of value, right? So in absolute terms, this is a massive, massive scale. And so everyone's like, well, the premium's as compressed as it's ever been. It's like, well, in fiat dollar terms, it's as large as it's ever been. So I think, there's people often are like, and we've seen this with analysts, kind of across the board in the treasury sector, people are comparing a company or companies that are 2 orders of magnitude in different size, right? And so I think, the expectations have to sort of be set there, where just the magnitude of like, okay, well, if you do your job and you execute well as a treasury company, the scale quickly approaches billions or tens of billions, right? If you can execute. And so, from that point on, maintaining, that sort of premium, One, it requires a lot of liquidity, and two, it requires sort of a kind of a dominant monopoly or a near sort of monopoly on your markets, liquidity, the Bitcoin vision. Part of I think why we were so successful early on, and I think still to this day, is that Japan, there was no Bitcoin exposure narrative or story, or really I would say visionary belief, right? Like when Saylor burst onto the scene in August of 2020, why did Bitcoiners rally around him, right? Because we were sort of all in our own little echo chamber, speaking the same language, and then some billionaire shows up on the NASDAQ and is like, there is no second best. And everyone's like, oh my God, And so I think there was somewhat of a parallel or like an analog there for us in Japan. There was no one. Everybody, if you believed in Bitcoin or crypto, you believed in digital asset Web3 blockchainisms, and that's not what we stood for. So I think that was part of the reason that we got such a jolt of a start. But in terms of like the U.S. markets, right? How many billions of dollars of Bitcoin exposure currently exist in floating? And that's a lot, right? And I think there's now sort of like private Bitcoin that is being taken public, right?
Yeah.
Versus like with Metaplanet, we have 16,000 Bitcoin. That's 16,000 Bitcoin of demand that didn't exist prior. It was trapped in the equity market. There wasn't exposure. We raised $1.6 billion and bought $1.6 billion of Bitcoin, right? So I think that just because of, the marginal sort of supply and demand, there's going to be, amongst the hundreds of companies, there's going to be sort of a natural, winner take most dynamic. But I think really the scale, ultimately, the real moat here, one is there's brand, right? There's a Saylor premium, in the same way that there's an Elon premium or there's a Steve Jobs premium back in the day. But the real moat here is, it's not just having a public company, right? Like a year or two ago or three, if you were a public company in the Bitcoin or crypto space, like that was a real differentiator.
Yeah.
Now there's a lot of crypto companies, and I think it was the ATM, right? The ability to raise equity at the market. Like if you've operated in public markets, raising money is a grueling game. It's like nonstop legal, regulatory, investor meetings, nonstop, no sleep, especially if there's like, sort of like, a private placement or convertible bond process where there's like a 3-day sprint window where it's nonstop meetings, roadshow, like it's grueling, right? And so, but the ATM, you get it live and then I don't want to say it's smooth sailing, right? But you do the hard work up front, and then the process gets, very much, it's easier throughout, right? Than constantly raising money. And so for a while, there was sort of a monopoly. Saylor was the only one in town doing this, right? And now I think there's, too many to name that are selling equity at the market to buy Bitcoin. Now, increasingly, there's some crypto digital asset companies, which is interesting. But I think, that's the real moat here is not just issuing equity to buy Bitcoin. The real moat is, can you hit a scale in absolute terms of Bitcoin exposure where you can access the fixed income markets?
Mm-hmm.
And I think Saylor and MSTR are to this point the only company that's hit that scale. Even convertible bonds, right? The convertible bond process it's long, it's grueling, it's heterogeneous credit, right? So every convertible bond has a new process, has new terms, and the investors don't actually believe in you, your story, or your company, right? Like the convertible bond investors, they'll woo you and they'll talk a big game and they'll talk about loving your vision, and then they short sell 60% of the money they put down to hedge.
Mm-hmm.
Like they're not actually even net long at all. They're just farming volatility, right? So like they're not your friend. And I say that's no diss, right? Like that's their business. They're in the business of trading volatility. That's fine. But with this preferred stock, I guess just with the preferred equities that Saylor's laid out, I didn't really see that vision wasn't clear to me until the first one rolled out, and then the second and the third, and then it's sort of like an aha moment. Like convertible bonds were never the end game. Like I thought the magic innovation was, okay, you can lever your balance sheet with Bitcoin volatility, and access 0% cost of capital. But now it's really clear that, that process was a bit clunky, and, it's also like the relative pool of capital for convertible bond arbitrage is pretty small, versus fixed income, broadly. I know that's a broad stroke term, but the fixed income markets, like the true fixed income markets, are absolutely massive. And so, so when Saylor said, we're going to go for every pool of capital, investment grade, junk, long duration, short duration. And now we're seeing that take form. So I think that's really that's really the only moat that exists for the Bitcoin treasury companies. And so I think implicitly, I don't know if anyone has, sort of said it out loud, but really every other company but Strategy, I think, is in a race to hit that scale to be able to access that market. Because, you can't issue preferred equity with $100 million of collateral on your balance sheet, because that's not interesting. Because what? Okay, you issue $20 million of fixed income preferreds. It's not worth an invest. It's like a real big investor isn't going to take the time to look into it, to trade it. It's not liquid enough, So you have to hit a scale to be able to access those capital pools. And I think that's the real monopoly. That's the real differentiator for the one company versus the 100th company.
This episode is brought to you by the massive legends Iron, the largest Nasdaq-listed Bitcoin miner using 100% renewable energy. Iron are not just powering the Bitcoin network, they're also providing cutting-edge computing resources for AI, all backed by renewable energy. We've been working with their founders, Dan and Will, for quite some time now, and have been really impressed with their values, especially their commitment to local communities and sustainable computing power. So whether you're interested in mining Bitcoin or harnessing AI compute power, Iron is setting the standard. Visit iron.com to learn more, which is IREN.com. Bitcoin is absolutely ripping, and in every bull market, there's always a new wave of investors, and with it, a flood of new companies, new products, and new promises. But if you've been around long enough, you've seen how this story ends for a lot of them. Some cut corners, take risks with your money, or just disappear. That's why when it comes to buying Bitcoin, the only exchange I recommend is River. They deeply care about doing things right for their clients and are built to last with security and transparency at their core. With River, you have peace of mind knowing all their Bitcoin is held in multi-sig cold storage, and it's the only Bitcoin-only exchange in the US with proof of reserves. There really is no better place to buy Bitcoin, so to open an account today, head over to river.com/WBD and earn up to $100 in Bitcoin when you buy. That's river.com/WBD. So I've got like a million questions from what you just said there. Let's start with, you were talking about these companies that are taking basically private Bitcoin public. There's obviously 21 and Blockstream's Bitcoin Standard Treasury Company, I think, that are about to go public. Have they gone public? I'm not sure. They're about to go public. And they're bringing in a lot of Bitcoin on, like 30, 40,000 Bitcoin. It's significant, but they're still a long way behind Saylor. Do you think these companies have any chance of ever catching Saylor?
Well, let me clarify that. It was no, taking the private Bitcoin public statement. There's no slight at all. Right?
No, not
I
at
think
all.
the more Bitcoin in public markets, the better. And I'm a huge fan of both Jack and Adam. I spoke, actually, coincidentally, I've had fireside chats in Amsterdam with both of them, 2 separate years, before any of this, unfolded. So, I'm really close with them, and it's really awesome to see your friends winning. With that said, I think that I think Saylor's reached escape velocity. I say that in the position of a public company. We have aspirations to catch Strategy. Is that feasible? I guess we'll see. But I think 600,000 Bitcoin lead, more or less, is pretty insurmountable. And so we will see. I think the beauty of it is Michael is welcoming the competition and cheering for them and retweeting them. And, I don't think I've really, I'm young, but I've thought pretty deeply about any sort of precedent where, a titan of industry is openly welcoming, cheering, and platforming all of their competition. And I can't find a parallel. So that's really interesting. But no, I think, the higher the Bitcoin price goes, the more the moat solidifies, the more they can access the fixed income market, repeat, rinse, repeat. So yeah, I mean, the really, like, the only way that it's probably not a Bitcoin industry incumbent, right? That if there is a potential challenger, like, if Mark Zuckerberg took the orange pill tomorrow, could he get close? Well, probably. I mean, Facebook has, Facebook makes $100 billion a year or something, right? So, or whatever the numbers are. So, yeah, I mean, that would be interesting, right? If Mark Zuckerberg took the orange pill, fired up an ATM and said, we're going to issue $10 billion preferred, that's an interesting story, but I don't think that's happening. I think the incentives aren't there. Just to, go all in on Bitcoin when so many other things are happening, right? AI and everything else. So I think, if I had to put my money on it, I would say overwhelmingly that MSTR is in the lead, just probabilistically 10 years from now, but we will see how how it plays out.
Okay, so I definitely want to talk about this new product that Saylor's just launched. But let's just hold that for 1 second, because when it comes to the premium on NAV, like you say, Saylor's at like 1.8 at the moment. You guys are at 3. You were at, how high did it get? Did it get to like 7, even higher potentially? Is that the only metric that really matters when it comes to this, or is that too much of a simplistic way of looking at this?
I mean, it's definitely a metric. It's probably one of the more important ones, but I think often people are looking at this, in a static form, right? So, for instance, what was it? A few months ago, Metaplanet's, let's say April, right? Metaplanet had a premium to net asset value of 3, and the share price was, $4, right? Metaplanet now has a premium to net assets of 3, and the share price is $8.80, right? So that's 3 months, and the stock was remarkably overvalued by the traditional analyst perspective, and now it's the same valuation, but it's repriced over 2x higher. And so I think I say that instead of one snapshot, I give you 2 snapshots, and I would pose an analyst or someone that someone from Wall Street to say, okay, well, how did this happen? Right? It's repriced twice as high, but it's the same relative valuation. And so there is somewhat of a forward-looking aspect here. The static premium to net asset value isn't considering all of the future that's baked in, right? Equities trade at a forward expectation of future cash flows is traditionally what it says, but it's really just forward expectations, right? There's a reason why Palantir trades at 100x revenue, and Amazon traded at 100 times earnings for 20 years, and right, it's pricing in the future, not the now. And so a Bitcoiner looks at strategy and they say, okay, well, they've generated $10 billion of BTC gain, and BTC gain not as the price of Bitcoin has gone up, but the BTC dollar gain metrics they've put out, or BTC yield, is saying, well, what value have you generated net, no dilution? So let's if you issued $10 billion of common stock at a 1x MNAV, you would have 0 BTC gain, right? There's no no additional value is generated or accrued. And so if you have a company that's generated $10 billion of value, that's worth something. And so the equity markets are rational, and they price, they put a forward multiple on that. And so I think that there's an entire industry of analysts that are trying to figure out what this is all worth. But that's sort of, the Bitcoiners at the same time that, everybody's investing in these equities. It's going up against the traditional world that has always looked at forward expectations, not the now, right? So like, Metaplanet, we've, this is rough numbers, so don't quote me, but when we first spoke, we had 100 Bitcoin, 140 Bitcoin, I think. And we had like post, split adjusted, it was like, I think we've 4x'd our share count, and we've like 100x'd our Bitcoin, right? And so it's like, well, how is that possible? And so obviously, analysts are going to just slap if they believe in the management and the execution, right? This whole flywheel and the net asset per share accrual can work in reverse theoretically, right? If you're selling equity at a discount to your fair value, to your net asset value per share can go down, right? Mm-hmm. So then the whole thing works in reverse. And so, yeah, there's a lot of ways, if the company has too much debt, or they don't believe in management, or, various reasons, maybe it's a Bitcoin bear market, right? There could be many various reasons that the, premium to net asset value goes to 1 or goes below 1, right? And then there's another toolkit there. But yeah, I mean, I think that there's not going to be one uniform answer, right? There's the scale of the company. Are you micro cap, small cap, mid cap, large cap? Are you in the Mag 7? All those things matter. there's some really interesting analysts in Japan that have come up with it's like they call it an MNAV. That's like a theory of MNAV decay. And they're saying basically, okay, theoretically, if you had 21 million Bitcoin as a company, what's your fair value MNAV? And the fair value MNAV at that Bitcoin holdings is 1, right? Well, how could you be worth more than 21 million Bitcoin in Bitcoin terms? And so then you take it to the other extreme. Well, if you held 1 Bitcoin, well, what's your fair value MNAV, right? And so the room for growth. And so there's like sort of a spectrum, right? The larger you get, the harder it is, or maybe mathematically, the market's saying, well, if you have 11 million Bitcoin, does it make sense to have a 2x MNAV? Well, that would be 22 million Bitcoin. So maybe not, right? And so I think that there's sort of there's different phases of the maturation process, but yeah, I think it's company dependent on the MNAV.
One of my questions would be if say 120k is the top for this Bitcoin cycle, like what do you think happens to MNAV across the board in a bear market? Because last bear market we saw Saylor go to a discount to MNAV. Again, like I know there's kind of orders of scale here, and maybe that won't happen again. But I assume you'll be more volatile both to the upside and downside in terms of MNAV. Like how do you see the market playing out in a bear market?
Yeah, that's a good question. I think that the broadly the asset class is a bit more mature. So that the profile of the just Bitcoin trading has definitely changed, right? Like last bull market we saw straight parabolic, and then it crashed, and then it ripped again in the fall of 2021, and then it had this huge epic crash. And this time it's like we sort of like slowly reprice, we chop for 6 months, 9 months. I think Checkmate, fellow Aussie, is like probably the best sort of
He's
analyst
great
these days around the chop solidation thesis, right? Of just like, hey, we reprice, we chop for 9 months, everyone gets bored, and then we do it again, and we do it again. So the terms like the big secular bear market thesis of like, okay, we're gonna 70% down, we're gonna all go home for 3 years, pack it up. I don't know if I put weight into that. I actually don't believe that will happen. It might, obviously, but everything's cyclical, right? So I think there will be a bear market. I think that during that period there will be pressure on MNAVs, as there's pressure on valuations of any company during sort of a secular bear market. But I think it'll be case dependent on whether various companies can manage that decline. One is, are you levered right now? How levered? With what sort of debt? Right? Do you have secured debt where your Bitcoin's encumbered, where if it goes, you have to liquidate the Bitcoin? Do you have secured, unsecured convertible debt? Right? Do you have debt due in 1 year? Right? Like if you have if you have a $2 billion treasury and $1 billion is due in 6 months, well, that could be a problem, especially if the credit markets freeze up and you can't roll that debt. Right. So it will be dependent. Part of the reason Saylor less preferreds is there's no debt maturity ever. It's just the dividends. Right. So that in terms of your flexibility, like one of the biggest things that everybody, all the, analysts, or the, commentators, if you will, would flood, create fear, uncertainty and doubt around is, well, okay, the converts are coming up. You're going to have to pay off all that and sell the Bitcoin. And so, with the press, it's like, no, we're not selling actually ever. And so, I mean, I also think in terms of the discount that Saylor traded at, the MSTR traded at last bear market, I think if I'm not entirely sure, but I think if you looked at the enterprise value, so you factor in the debt into the market cap, that if you looked at just face value market cap to Bitcoin holdings, it looked like it traded at a deep, deep discount. But the reality was like, at the bottom, he had a couple billion of Bitcoin and a couple billion of debt, right? So in reality, the discount wasn't as severe as it looks. But it's still, the conditions were pretty rough, right? So I think for us, we're focused on staying, keeping a pristine balance sheet, maintaining maximal flexibility. We don't want to be put in a tough spot. So we've kept the leverage pretty low. If I, off the top of my head, I think our Bitcoin to debt, our BTC rating, as Saylor calls it, is like 16x, I believe, right? So we have like 100 million of debt, and it's 16.5x is our BTC rating. So we have $16 of Bitcoin for every dollar of debt. That's intentional. And I think, when the opportunity arises, we will look to, increase that leverage ratio a bit. But it's going to be, there's going to be companies that trade at a discount. There's going to be companies that trade at large discounts. There's probably going to be a sort of a acquisition merger, season, if you will, right?
Mm-hmm.
There'll be opportunists, clear off some debt, buy the Bitcoin at a discount. That's a very familiar world for the traditional, financial Wall Street world. And so I don't expect that to change. But that's, at least at Metaplanet, that's not our intended strategy. We're pretty laser focused on just BTC. If someone else wants to do the acquisitions and all that, then have at it.
Like one of the reasons I like talking to you about this is because you're definitely a Bitcoiner first. Like you before you joined Metaplanet, you were already like very deep in this world. I think there's a lot of people who are trying to copy this play who are kind of cosplaying as Bitcoiners because they see kind of a gap in the market. From your just like pure Bitcoiner perspective, what do you think of this cycle so far? Do you think we are out of the sort of traditional 4-year cycles? And how much does people like Saylor play into that in the sense that they're kind of a buyer regardless of price?
Yeah, it's interesting to kind of come from the Bitcoin world, if you will, and then sort of enter the traditional financial world and kind of see it through both lenses. Yeah, I mean, to be honest, I obviously I can feel, you can see that there's certain people that are more convicted than others.
Yeah.
I think investors can see that too.
Mm-hmm.
The fact that, we can, I mean, Simon was in the, not publicly, but he had some Bitcoin on Mt. Gox and, saw the last 10 years of craziness, the good and the bad, right? I had sort of been talking about strategy and Bitcoin and everything else for the past 5 years. So it was a pretty natural fit, plug and play at Metaplanet. It was just like, okay, let's go, turbo hyperspeed. Everything is 110% Bitcoin. I think now it's like it's sort of the opportunistic phase, and I don't think that's a bad thing. I think it's perfectly rational. The real conviction or test is like, can you eat the 70% bear market, right? If it comes, right? Whether it's 60 or 50 or 40%, who knows? But that tests your conviction, right? I mean, outside of the Bitcoin price, like in the 15 months since I've joined Metaplanet stock has fallen 50, 60, 70%, like three times, maybe 4, depending on where you're measuring from. Right. So like we're speed running a Bitcoin cycle, like every few months, once a quarter, maybe. And so I think that, that sort of not test your conviction, because we didn't change anything. We continued on unabated, nothing changed. We didn't waver. But for the person from the traditional world, right, if you're just stepping into this new, you're opportunistic, that sort of move will test your conviction, will test your will, test your kind of resolve. So yeah, I mean, I think there will be some wipeouts. I mean, the reality is, like, as I'm a diehard Bitcoiner, but it's naive to say that every company that adopts Bitcoin will be a success. Like, there will be failures. I mean, it's like every company that adopted the internet didn't succeed. Like, there was failures. So there will be failures. There will be a bankruptcy. Like, there will be, it's not all good. It's not all sunshine and rainbows. It's a brutal competitive world. There's a lot of sharks out there in Wall Street and everything else. So yeah, I mean, I'm not naive to that. So yeah, I mean, the times are good now. Bitcoin's around the all-time high. There will be a cycle. And so I think that's what will separate the men from the boys, if you will. But until then, I think that, yeah, we'll see what happens. But, I think we're really focused on staying disciplined, and managing risk responsibly in a Bitcoin standard, right? And for us, managing risk means buying as much Bitcoin as we can, staying delevered, and making sure we can weather any storm.
Yeah, and one of the most interesting things in this world that's come out in the last few weeks really is this kind of pivot from some companies to go to like crypto treasury companies. I think it was Bit Digital sold their Bitcoin and bought Ethereum, and the share price tanked. What's your take on that? I mean, I think I know the answer, but give me your take on that.
Yeah, I mean, not to say I don't agree with it, because you're free to do whatever you want, but yeah, it's clear to me that it was going to happen. I was surprised it took as long as it did, but at the same time, there's a reason that I'm a Bitcoin maximalist. I turned down a lot of financial and whatever opportunities over the years because it was crypto related, right, and not Bitcoin. And I'm focused on what I believe in, which is Bitcoin. And so, the XRP Treasury company, I mean, to be honest, it's not clear to me that a lot of these things are commodities. And so I know the SEC has sort of rolled back some stuff, but if you are capitalizing on a security, there's a different set of rules, at least in the US. But I guess that's another question. For me, it's pretty simple. It's just like, chart any of these things. And even if you're not an analyst or someone that likes to chart things, just look at any of the altcoins denominated in Bitcoin, right? Like, it's pretty clear.
Yeah.
Right. Like, the past couple of days, I've heard, on the Ethereum Treasury company, someone said, well, Dylan, you guys aren't getting a yield on your Bitcoin, and they are. And I was like, yeah, well, you can get a yield on your fiat. It's still underperformed Bitcoin, So like, the point is, like, the crypto companies or whatever, like, or the alternate cryptocurrencies, the altcoins, something like ETH staking yield, like, it's just recycled dilution. The reason that ETH BTC has gone down only since the merge with a dead cat bounce in the last week is because of, people realize that there was like a fundamental shift in the protocol. It's not nuclear weapons grade like Bitcoin is, and it's it's a VC bet, it's a venture bet, it's a tech, it's like Tesla, it's something with, a team in charge. It's not a kind of an autonomous protocol like Bitcoin. So yeah, I mean, I wouldn't be comfortable building a lasting foundation on any altcoin. And I, obviously you agree there, but I think it's more so there was obviously going to be some copycats. It's funny that, like, the Ethereum people in general, or the crypto people, religiously mocked Michael for years, like, he's buying the top. What is he doing? He's averaging up. He doesn't understand this. And now they're all like, it's finally, after looking into it all in the last 2 weeks, they've realized that, whoa, the public capital markets, so it's a funny, change of events, I guess. But I wouldn't say I'm shocked.
Yeah, a 7% yield when you're down 50% on Bitcoin doesn't sound like a great trade.
Yeah. Enticing.
What if you could lower your tax bill and stack Bitcoin at the same time? Well, by mining Bitcoin with Blockware, you can. New tax guidelines from the Big Beautiful Bill allow American miners to write off 100% of the cost of their mining hardware in a single tax year. That's right, 100% write-off. If you have 100k in capital gains or income, you can purchase 100k of miners and offset it entirely. Blockware's mining as a service enables you to start mining Bitcoin right now without lifting a finger. Blockware handles everything from securing the miners to sourcing low-cost power to configuring the mining pool. They do it all. You get to stack Bitcoin at a discount every single day while also saving big come tax season. Get started today by going to mining.blockwaresolutions.com/WBD, and for every hosted miner purchased, you get 1 week of free hosting and electricity. Of course, none of this is tax advice. Speak with Blockware to learn more at mining.blockwaresolutions.com/WBD. One of the things that keeps me up at night is the idea of a critical error with my Bitcoin cold storage. This is where AnchorWatch comes in. With AnchorWatch, your Bitcoin is insured with your own A+ rated Lloyd's of London insurance policy, and all Bitcoin is held in their time-locked multi-sig vaults. So you have the peace of mind knowing your Bitcoin is fully insured while not giving up custody. So whether you're worried about inheritance planning, rent attacks, natural disasters, or just your own mistakes, you're fully protected by AnchorWatch. Rates for fully insured custody start as low as 0.55% and are available for individual and commercial customers located in the US. Speak to AnchorWatch today for a quote and for more details about your security options and coverage. Visit anchorwatch.com today. That is anchorwatch.com. Do you wish you could access cash without selling your Bitcoin? Well, Ledden makes that possible. They're the global leader in Bitcoin-backed lending, and since 2018, they've issued over $9 billion in loans with a perfect record of protecting client assets. With Ledden, you get full custody loans with no credit checks or monthly repayments, just easy access to dollars without selling a single sat. As of July 1st, Ledden is Bitcoin only, meaning they exclusively offer Bitcoin-backed loans with all collateral held by Ledden directly or their funding partners. Your Bitcoin is never lent out to generate interest. I recently took out a loan with Ledden, and the whole process couldn't have been easier. The application took me less than 15 minutes, and in just a few hours I had the dollars in my bank account. It was super smooth. So if you need cash but you don't want to sell Bitcoin, head over to learn.ledden.io/WBD and you'll get 0.25% off your first loan. That's learn.ledden.io/WBD. Let's talk about Strategy, because they've just come out with a new product. I think it's really interesting. Shout out to Odell. He called Saylor building a stable coin quite a long time ago. And I know it's not a traditional stable coin, but it kind of essentially is. Do you want to explain what Stretch is?
Yeah. I didn't see it coming. I should have seen it coming. I put out a few sort of thoughts or ideas the past couple of weeks. That I think if we kind of take a step back, people are talking like Bitcoin treasury companies are a new idea. It's a new model. The reality is, like, in the kind of the long arc of history, Bitcoin treasury companies aren't really that unique, right? Like, if we think of the model of like the central banks of the past or the banks of the past, right? What are you doing? You're capitalizing on a hard asset, gold, and you're issuing liabilities against that, right? And as fiat or gold-backed IOUs or whatever it was. But if we think of all of the reasons that these financial institutions of the past failed, it was basically an asset. It was these were fractional reserved banks, right? So they would issue all this these liabilities and money they didn't actually have, and just hope that they wouldn't get bank run. But also, in that process, they were a lot of the gold banks of the past. They were issuing the liabilities were redeemable in gold, right? So not only were the liabilities callable at any one point, but they were in the hard asset, right? And so when there was any sort of crash or financial crisis or whatnot, all of a sudden, and there's a rush to gold, all of a sudden your liabilities, are much more valuable, and there's a run on the bank, and you're toast. So the reason we got to fiat in the first place was because the hard asset treasury companies of the past failed spectacularly over and over and over again. So, like, if you had to think, like, if you were a monetary theorist of the past and you said, okay, well, let's design a financial institution that can't fit, that solves every problem that we faced or face today, back 200 years ago. Well, you'd want the gold to teleport. You would want there to not be able to mine any more gold, so to devalue your assets. You would want your liabilities to not be callable, to not be able to be run on your liabilities. You'd want them to be perpetual. You wouldn't want them to ever come due. And you'd want the currency your liabilities are denominated in to be printed forever, right? Like, theoretically, if you had to optimize like a perfect bank of the past on a gold standard, that's what you'd want, right? And so when you think of what Michael is doing, if you think of what Strategy is doing, they're capitalizing on Bitcoin. Obviously, we know that. It's better than every way than gold. We know that. Bitcoin talking point 101. But the real interesting thing is the engineering and innovation on the liability side. And they've kind of tested this out all in public, right? If you think about the maturation of their liability profile, they first, MSTR first issued convertible bonds. They did a couple converts. They did a senior note, so just a straight bond. They issued that through a subsidiary. So they put, 100,000 Bitcoin in a subsidiary. They issued a bond against it. It was encumbered collateral. That Bitcoin was, first claim before all the equity was secured, right? They went to Silvergate and did an over-collateralized loan, and everyone in the bottom of 2022 was saying, Saylor's going to get margin called. He's going to get margin called. You better sell your yacht, Michael. Like, right? So they tried everything, right? And they, did more converts in 2024, and the perpetual preferreds now, I think this is sort of kind of the final evolution of what theoretically the best liability profile for a hard asset treasury company financial institution looks like, right? You have the perfectly engineered asset, Bitcoin, but on the liability side, you want something that's perpetual, denominated in a bad money relative to what your asset's holding. It's going to devalue forever. That can't be called, right? And so, Strike and Strife were interesting. Strike is essentially a tokenized convertible bond. Strife is, a perpetual Bitcoin dollar swap that has a duration of, 1,000 years. But, Stretch is really interesting, right? Because, there was that report from like Bernstein, I think 6 months ago, and it was like Strategy wants to become a neobank. And everybody interpreted that like, oh, they're going to, acquire a bank, and they're going to become, get a commercial banking license and, service deposits. What they did is actually much, much better. Being a bank is a total nightmare. Infinite regulatory hurdles and red tape. There's a limit to what you can do on the balance sheet. There's, it's a total nightmare. And so instead, it's like the Stretch is essentially they're issuing a stable coin. It's sort of a neo stable coin that's perpetual, right? And so I think that it's a pretty genius feat of financial engineering. I think that the total addressable market for Stretch is huge. It's like every dollar in money market funds. I understand that money market funds are a technically different thing from a regulatory perspective, and maybe there's just a lot of money that's siloed in those accounts that won't leave to go to a brokerage account. But like, how many Bitcoiners do you know, or people we just our conversation just before this, right? You're talking about, if you have extra cash in a brokerage account, what do you do with it, right? Stretch is short duration. It's a cash equivalent essentially. I understand it's technically different, right? But yeah, it's the theory. There's this trilemma problem in international economics. I posted about it yesterday.
I saw this tweet. Can you explain this trilemma?
Yeah, so essentially, this is a sort of kind of an international economics problem, theoretical, where you can only have two of three. You can have an open capital account, you can have a fixed exchange rate currency, or you can have control of your interest rates. You can't have all three, right?
Mm-hmm.
And so, like for instance, the U.S., we have an open capital account, we control our interest rates, but the dollar floats, right? Something like China. They, I guess it's debatable whether it's, they truly have an exchange rate peg. They have bands, right? But they control their interest rates. They control the kind of the price of their currency, but they have a closed capital account, right? And so Strife, Strike, and Stride are essentially, I know this is not they're not a sovereign issuing their own money, but if you can sort of, pick up what I'm putting down, these are monetary instruments. And so, right, obviously there's free capital mobility. And in terms of what monetary autonomy means is, are you setting your own interest rate? And so with Stripe and Strike, they set the interest rate. It's fixed, right? The dividend is fixed in perpetuity, but the exchange rate floats. And so what Stretch is they just decided to flip it. And they said, okay, obviously there's an open capital, there's free capital mobility, but we're going to fix the exchange rate at 100 or between 101 and 99, and we're going to let the interest rate float, right? And so this is basically a market. They're going to decide the Stretch rate every month, but essentially this is going to be a free floating, essentially currency that exists. And I think it'll be, it'll have a premium to T-bills because the U.S. is a money printer. But yeah, I mean, this is quite the financial engineering instrument. I mean, it's really, really impressive.
But with all their products, they're covering every side of this triangle.
Yeah. Well, not C, right? They always have an open capital account or capital mobility. But like for another example of this from at the sovereign level is Hong Kong, right? They have an open capital account, right? And they manage the price of their money, right? It's pegged to the dollar, but they don't have monetary autonomy, right? They follow whatever interest rates are set by the Fed, right? So this is sort of kind of an age-old question or theoretical choice for sovereign nations. And so, yeah, it's it's interesting that I think like people like Checkmate and Odell and kind of they said, oh well, yeah, Saylor will create a stable coin, or Check and I had a conversation in 2022 where we said, really from an engineering point of view, the biggest, the golden goose of crypto generally, like what all of the Ethereum DeFi engineers were chasing for all of this time, for years, was, okay, how do we make a stable coin that's decentralized, that's not, and I understand that this is centralized. It's listed on the NASDAQ by a Delaware company. But the interesting thing is that no one could really figure it out. I understand it's not a decentralized oracle, and it's not this like, cipher crypto anarchist holy grail that they were intending for, but all of crypto has been spending a lot of time to try to figure out, how do we make a stable coin that's not some T-bills or money in a bank account that's sitting in Circle's vault or Tether, right? Like how do we do this? So they tried DAI, they tried all these different options, and none of them caught on. And Saylor just listed it on the Nasdaq, and none of the crypto people that have been trying this for 10 years have even said anything about it. No one even knows. So yeah, I mean, I think that Stretch might be the most in-demand product of the preferreds, right? Because with Strike and Strife, there's a very high interest rate, but you're taking what's called duration risk, right? And so it's like the reason that if this is just sort of some finance jargon, but if you have a 1-year bond or a T-bill, or you have a 30-year bond, right? A 1% change of interest rates for a 1-year instrument doesn't change much, right? If interest rates go from 5% to 4%, the value of your money doesn't change much. You get less interest, but the value of your money stays pretty much the same. If you put money in a bond, at 4%, and it goes, or let's say 2%, and it goes to 3% or 4%, the yields, the value of your money you put in collapses. This is what we saw in 2022, right? The whole, the Bank of England and the, all of these bond markets were imploding because interest rates went from 1% to 4%, and the bond market got cut in half. And non-finance people were like, what do you mean the bonds fell by 50%? That makes no sense, right? But that's just kind of how do these things work. So, with Strife and Strike, these are long duration instruments. So, people last week, they bought at 125 and now it's at 116, and obviously long-term investors, they understand this and they understand where this is all going, and they're not too worried about that, right? But the beauty of Stretch is that there's no duration risk. I mean, I'm not saying no duration risk, but there's minimal duration risk. It's a perpetual instrument, but because this interest rate's floating and not fixed, it's going to be a stable price. At least, this is the target for Saylor and team. So, yeah, I mean, I wouldn't be surprised if we saw huge demand for this instrument. They intentionally priced the interest rate at 9. I think they know that that's extremely attractive, and so yeah, I mean, another tool in the arsenal, and money market mutual funds and cash equivalents and stable coins. That's that's a real big game. It's also, I think it's a bit ironic and a little funny that the sort of the meta of crypto. The crypto industry has been stable coins, right? Everyone's like, what's the real use case for this? Okay, yeah, Bitcoin, but that's for boomers. That's boring. What's the real use case? Where can I make money on this from this industry? None of the Ethereum or Solanas or none of this is interesting, but stable coins have a real use case. And, Circle's IPO was a huge success. And now everybody's sort of looking, okay, well, where's the next sort of opportunity here? And MSTR dropped a stable coin at 5 p.m. and no one even said anything. It's just the Bitcoiners on Twitter, right? So
Yep.
It's pretty ironic in my opinion. It should be much bigger story than it actually has been so far.
Especially when Circle and Tether have both been told they can't offer yield on their stablecoins, and then Saylor comes out with this product that is offering, at least at inception, 9%. I would like to get your opinion on where that dividend rate will go. But before we do that, just because we've talked a little bit about this, but for anyone who's not been following this closely, who didn't see Saylor's presentation, like how does he retain the peg to close to $100?
Yeah, so there's a few options. Above 101. One, they don't have it yet, but they're going to attach an ATM to this, meaning that if the price rises, they're just going to issue more securities. They're going to print more Stretch STRC, and they're going to sell it on the market so they can drive the price down. They have a call in this at 101, right? So they are legally, they're allowed to basically, take your Stretch and give you $101 in return at any point. And so with these other preferreds, so the preferred market's interesting, right? Because for bonds, there's 5-year bonds, 10-year bonds, 20-year bonds. Preferred equity is interesting because there's a concept there's perpetual instruments, right? And so it's perpetual means forever, right? And so, in the history of finance, this perpetual preferred instrument isn't used much or too popular. But if it was issued at all, right, there was always a call in it, meaning that if I'm a company A, and I want to issue preferred equity, and I issue perpetual preferred equity with an interest rate, right? That means I'm on the hook for it forever. So any rational CEO or a management team says, okay, well, if the price rises or our conditions change and we don't need the financing anymore, we want to call it in, right? And so perpetual preferreds were always perpetual in name, but not actually, right? And Saylor's innovation was like, no, we want to make this the best credit instrument possible, and we're accumulating Bitcoin, and our belief is Bitcoin appreciates relative to fiat forever. So we're not going to give you, where there's no call, right? And so this like sort of melted a lot of, Wall Street minds when they said, no, we don't want the call, right? Because the call hinders the value of the call option and strike and everything else. But with Stretch, unlike the other preferreds, they do have a call. So they can call it in at 101, right? So they have ways to sort of, kind of manage the upside. They can also lower the interest rate, right? So if Stretch is at 101, 102, it's constantly, higher, and, they are not selling the ATM for whatever reason. On Stretch, they can lower the interest rates. They can do this once a month. Conversely, on the other side of this, what if it falls, right? The real worry by some is, creating sort of a synthetic stablecoin as well. The downside, right? What if there's sellers or short sellers, or people get scared and all dump at once? And there's a few tools. One is, the people that are comparing this to like previous algo stablecoins or whatever. It's just a total joke. Like it's totally different. One, because if the price of Stretch falls to $95 or $90, they're not selling any Bitcoin. Like there's no like force redeem function here where everybody's going to all panic at once and take all of the collateral. Like it's like that's not going to happen. They're not going to sell the Bitcoin. There's no redeemability for the user or for the owner of the preferred. They can't just take the Bitcoin and run like you could with some crypto, science experiment. The second is that, if it falls, they're just going to raise the interest rate. Right. And I mean, if their intention is to keep it at 100, and you have that, so sort of trilemma, right? Well, they said, we have open capital account, and the exchange rate is going to be fixed at 100 or whatever. So if it falls, and they said, they acknowledged, hey, we're going to raise 500 million in the IPO. If we sell it at 100, it's going to be a 9% instrument. If we sell it at 95 or 90, it could be a 9.5 or a 10% instrument. So that means like they could IPO. I expect it to be at 100, but it could, like the previous preferred instruments, it could open below the IPO price. It could open at 85 or 90 or 95. That's not out of the question. So what does that mean? It means that, in a month, they're going to raise the interest rate to 9.25% or 9.5% or whatever they raise it to, right? And theoretically, that will draw in capital. So yeah, I mean, I think that there's a ton of runway for these preferreds. I think Strategy is really looking forward to, they mentioned it in the presentation, to let these converts roll off. And then you have really like a pristine capital structure. I mean, it already is a pristine capital structure. You have 70 billion of Bitcoin and, 10 billion or so of combined liabilities, but 50% of this converts are already through the strike price. It's already basically quasi equity that hasn't converted yet, right? So yeah, I mean, there's a ton of runway for these preferreds. I think there's a huge untapped demand for, dollar equivalents backed by Bitcoin. Unlike previous sort of algo stables, if you will, or synthetic over collateralized stable coins is probably a better term. This is like 7x over collateralized, right? It's like, okay, you issue a few $1 billion of preferreds, but it's 7, 8, 10x over collateralized. That's unlike anything that's ever been tried and tested in crypto before. Why? Well, because if you wanted to make a 7x over collateralized stablecoin, it's super capital inefficient. Like if you're familiar with crypto DeFi or whatever, the Ethereum DeFi complex created DAI, DAI, right? And so decentralized autonomous something. I forget exactly, but that whole idea was, let's create a stable coin backed with crypto collateral. And they first did it with ETH, but the problem was nobody wanted to put their ETH idle to back a stable coin for no reason, right? And so like it was really capital inefficient. So what ultimately happened with DAI, the product? Well, it ended up being like 50% collateralized with USDC. The decentralized algorithmic stablecoin on Ethereum was backed by the centralized stablecoin because it was more capital efficient to just back it 1-to-1.
Yeah.
Than to like take a bunch of Ethereum and so like if you wanted a real safe stablecoin on Ethereum, you could have theoretically backed it 10-to-1 with ETH for every dollar of the stable, but nobody wanted that because it was capital inefficient. So there was no product market fit for this. And so that was the same sort of problem with all the other synthetic stablecoins, that existed. Strategy saying, no, this is going to be senior to the common equity, senior to, two of the preferred instruments. And ultimately, once these converts roll off, it'll be the second in the capital structure, right? So you have a supremely over collateralized stablecoin that's probably going to be paying you, 5, 6, 7% interest. And so, while the rest of crypto tries to sell you on, holding a stablecoin with no interest, right? So that's I think it's not really a close competition. And it sort of inverts the model. All the stablecoin companies are issuing stablecoins, not paying you interest, and then collecting the interest for themselves. Strategy saying, no, we want the liability, and we're going to buy Bitcoin because that's what we believe in. Which if you had to say, Dylan, would you rather sit on, would you rather sit on a bunch of cash that, other people have a claim to, but you collect the interest, or would you rather be levered long Bitcoin forever? I would choose the second, right? I would want to be levered long. So I think it's a much superior model. Never mind, we're not even talking about the nightmare of compliance and KYC, AML, and money laundering, and blah 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 that you have to deal with as a stablecoin issuer. So yeah, I mean, it's like the best of both worlds. It's like it's sort of an entrance into the quasi banking system / stablecoin world without servicing any true, they're servicing customers. They're not servicing customers. They're servicing investors, right? And that's a much, much better world to operate in my opinion.
Yeah, I totally agree. And I assume this is going to be massively, the demand is going to be huge for this. What happens to the interest rates there? Because I assume the Fed's fund rate basically sets a floor that it likely won't go below. But do you see this trading down to like 5, 6%?
Well, so the beauty of it is the floor is actually the SOFR rate.
Okay.
So the lowest interest rate will ever go is actually the Fed funds rate. But yeah, I think it'll be market driven. To be honest, I think that there's I believe, and I have to read the documentation more clearly, but I believe the most they can lower the rate per month is 25 basis points.
It's like their difficulty adjustment.
It is, right? It is the difficulty adjustment. And so, yeah, there's, once a month, they're going to declare the stretch rate. They're going to pay the dividend. I think that, and also anybody that's making a fuss about the dividends, they have to pay is totally just missing the scale of this all, right? They have raised the dividends they need to pay for in a quarter in an afternoon of trading and no one noticed, right? Like strategies, common equities, supremely liquid. So that, that doesn't worry me at all, to be frank. But, yeah, I think the interest rate on stretch probably, it ultimately settles, just right above the risk-free rate, probably in the long term, with a bit of a spread just for the any perceived credit risk. But yeah, right, probably I wouldn't be surprised to see 6% in the, or 200 basis points above the Fed funds rate in the near term, or the short medium term. But probably should go lower than that, to be honest. Right? There's not another issuer of fixed income that's this over collateralized, that's this transparent. Everyone else that's borrowing money doesn't have it. I guess, the big tech companies have the money and they just borrow it to get some leverage. But most of the borrowers in the corporate credit market are companies that need the money that don't have it. Right. And they don't have collateral. They have, future discounted cash flows to pledge. Right. So, yeah, that's the real innovation, is that they have the money. They don't need it. They're just doing it to get some operating leverage. And the collateral is transparent and homogeneous. So, yeah, it should be a pretty low interest rate, to be honest. And yeah, short duration too. We're not even talking about what happens 12 months from now when sort of a patsy Fed chair is put in.
That's if it takes 12 months.
Yeah, true. Right. And a Fed chair resigning from decree of the president or prime minister is sort of what happens in banana republics. And I would implore anybody to sort of look at what happens to the bond market in those scenarios. Ask someone from Turkey what happens when Erdogan fired their their central bank chief. So yeah, this is all very, very pro BTC. And I say that, not political or social or whatever, but just purely from like a flows fundamental standpoint. There's a lot of people in finance that are saying, oh, wow, well, if that happens, then I really wouldn't want to own bonds. It's like, well, yeah, no kidding. Like, where have you been? So all of this is it's the tailwinds are supremely bullish for strategy and for Bitcoin and for Bitcoin treasury companies.
All right, last question on Saylor, because when I was watching his presentation of Stretch, he was talking about something else that I thought was interesting, where he was talking about equitizing the convertible notes. Why would he do that? Is that purely just to deleverage the company?
I think it's because they're sitting senior to the preferreds.
Okay.
So right now, the preferreds, outside of the fact that the convertible bond guys are sort of, I guess it depends where the strike is, but a simple model is when the price of your stock goes up, they're shorting, and when the price of your stock falls, they're buying, right? And so there's never been a serial issuer of convertible bonds like MSTR, partly because there's never been a collateral or a use of proceeds as strong as Bitcoin, but more so because you do a convert or two or three, and I mean it's basically like I guess the equivalent. This isn't a perfect metaphor or analogy, but it's sort of like you're squeezing the volatility out of your stock, right? It's like that's what their job is that they're gamma trading, which, not to go into the weeds, but they're essentially like neutering the volatility. They're dampening the volatility intentionally, right? And so Strategy's business model is like, we want to be hyper volatile. And so part of it is, one, I think for the converts is there's a maturity cliff. So if your stock isn't high enough, then you have to come up with the money or, refinance and do another convertible bond. So that's annoying. It's like sort of a FUD talking point. Two is the they're gamma trading it. So they're stripping the volatility and dampening the volatility. And then three is it sits senior to the preferreds, right? So there's Strategy's come out with a risk model that says, okay, Bitcoin has a volatility of X, and we expect the return profile of Bitcoin over the next 10 years to be Y. And, there's, this much collateral, there's 10 times the collateral as there is the debt. And so what's the probability of, your Bitcoin, your debt position being under collateralized? So if you own this preferred stock, what's your probability of us having less Bitcoin, than we have of debt outstanding, right? Or, not insolvent, but, you're in a bad position. And so when you do the math now, those converts, those $8 billion of converts, it means that there's a lot less collateral left for all the preferred equities. So I think when they want to equitize the convertible bonds, because it basically allows their preferreds to be that much more collateralized. And, essentially it creates a more runway to issue more preferreds is really what the unlock is there.
That makes sense. Okay, cool. So then to kind of close out with this, what do all these products that Strategy are now issuing mean for the other treasury companies? So like for you at Metaplanet, do you see this as we have to do something similar or we get left behind?
That's an interesting question. I mean, I think what it means is that, for Bitcoin in general, is that the asset is maturing. And this is a way, if Bitcoin is going to eat the world, and that's what kind of a lot of us came to the conclusion of 5 years ago, then it's not going to be everybody just buying Bitcoin on cold cards. Mm-hmm. There's huge pools of money that can't access the asset. And so, common equity, just, equity on the stock market was just the first pool. And, really the bigger market in terms of exposure is the credit markets, right? So there's preferred equity, there's debt, the sovereign, bond market is much, much bigger, right? And so if Bitcoin is going to entrench itself in the financial system, it has to get to all these, different pools of capital. So I think that's the bigger idea. In terms of like the competition between the treasury companies, I mean, the preferreds, not only just having preferreds authorized, never mind having them issued, but having them be issued, liquid, and a sufficient scale is a whole nother story. And I think that, kind of circling back to what we said earlier, like that's not the only true moat, but one of the strongest, right? Is, I think of preferreds as, for Strategy is in two ways. One, it's offensive, right? We're levering the balance sheet. We're buying more Bitcoin. We're increasing Bitcoin per share. We have the potential to buy back our stock, right? Saylor said, hey, if MNAV gets to one or below, or maybe even above one. I'm not sure if he said that, but we can buy back. We can issue stride and buy back our stock. He said that, right? And so if you're a short seller and your thesis is, okay, well, they're just, they're sort of dribbling in stock every day, and let's just front run them and, play this MNAV compression game. And all of a sudden, even if the strategy scale, even if Saylor goes and buys back 100 million of stock, which is not that much for Strategy's $150 billion scale, right? But all of a sudden, those flows go the other way, and so someone like a short seller has to unwind and get out, right? So it's the preferreds are both like an offensive tool and it's defensive, right? Like I think of preferreds as it's like an MNAV defense mechanism, right? It's like, okay, well, if the the short sellers and the arbitrageurs are really trying to short sell, like Jim Chanos, right? His whole thing, it's like, if you listen to Jim Chanos, he's not just a belligerent hater of Bitcoin or Saylor.
Totally.
Far from it. He's just saying, he's like, actually, I get Bitcoin, or I don't know how much he, quote unquote, gets it, but he's like, look, I get the trade. I'm just, playing the spread game, right? And kind of like dancing in and out. And so with the preferreds, like it gives Saylor or, the operator sort of an option to, okay, we're going to continue to stack Bitcoin every week because that's our mandate and that's what we said we're going to do and that's our business. But at the same time, we're not going to put the pressure on the common shareholders. One of the kind of the misconceived notions that people had is the convertible bonds, right? Like people see the leverage as something that's positive for the common. And that could be true, right? Increase the leverage, $1 billion of Bitcoin, especially like, a couple of years ago, makes a material difference in the market. So there was all these reasons it was supportive. But under the hood, when they came out and says, okay, we're going to raise $1 billion of convertible bonds, under the hood, there someone like myself a few years ago, or analysts or commentators would be confused because the stock would drop. It's like, wait, they just raised $1 billion to buy Bitcoin and the stock went down? It's like, well, yeah, the convertible bond desk just shorted 500 million of stock after trading, And so the reality was, like, it was sort of paradoxical. It's like, okay, well, we're going to lever up because we don't want to sell some common, but it's essentially, it's like you're selling 50% of the stock. It's like half the sell pressure as you would get by just selling a straight equity. So the preferreds are totally different. It's a completely different profile of investor, right? And so, they're on the journey with you. They're contributing. They're aligned with your worldview and the 20-year vision. The convertible bonds are not the same. So I think the preferreds, how I think of them, in the treasury space, I think it's definitely, the credit market, Bitcoinizing the credit market is a much, much, much bigger fish than Bitcoinizing the equity markets, right? Or equitizing Bitcoin. It's just a much, much bigger game. The pools of capital are huge. Never mind long duration and short duration, right? And so, yeah, I mean, I'm a big fan. I think from a financial engineering perspective, it's absolutely fascinating and historic. And I think that, that's the real, that's the real golden goose is, can you get those figured out? Can you get those live? Can you get those liquid? And can you hit a scale, where whether it's your local market or just globally that, you can, sort of really carve out I don't know, maybe a monopoly or a quasi-monopoly, in one of these markets. Because I think, anyone, especially in the US, that's saying, okay, like now we want to issue preferred stock, you're going to have to issue it at a spread to Saylor, right? Because Saylor has more Bitcoin, he's more liquid, he's more established, he's a seasoned issuer, he's been on the NASDAQ for 35 years, he's been at this game for 5, right? So like if you want to issue perpetual preferred like a Strife and you're in the US on the NASDAQ, well, he did it at 10, you got to do it at 12. Right. So I think there's like, this is the benchmark. This is like almost like the Bitcoin risk-free rate, if you will. And, obviously all those instruments are different, but yeah, that's sort of how I think about it. I think, the fixed income markets in general, are, definitely in need of a revamp, or, kind of a revitalization, and Japan notwithstanding. So, it's an exciting time.
It really is. That's really interesting. I've not heard this described as like an MNAV defense mechanism. That makes a lot of sense. I think I've been mid-curving the Treasury plays to a certain degree. This has definitely helped me. I've really enjoyed this, Dylan. Thank you for giving me the time. Where do you want to send anyone to find out more about you and Metaplanet?
Yeah, you can. Well, one, Danny, I appreciate you giving me the platform. It's been too long, so it's great to catch up. We have to do it in person next time.
For sure.
But yeah, you can just you can find me on Twitter or X, Dylan LeClair _ or for Metaplanet, we also on X, or you can just go to metaplanet.jp, Japanese domain, if you want to kind of see what we're doing. So yeah, that's I think that's all I got.
All right, cool. Thank you, Dylan, and definitely in person next time. I'm sure I'll see you around at one of the conferences at some point soon. But I appreciate you, man. Thank you.
Indeed. Cheers.